Hello. With me today is Filipe de Silva, Chief Financial Officer of Alimentation Couche-Tard. Welcome, Filipe.
Thanks, Kevin, and thanks for having me today.
So, Filipe, let's start with strategy. You joined Couche-Tard in March, you became CFO in July, and then just last month, the company rolled out its 10 for the Win strategy. That's a strategy to reach $10 billion of Ebitda by your fiscal 2028. That would be up from about $6 billion of Ebitda now. Please walk us through that strategy and how Couche-Tard is going to hit those targets.
Yeah, sure, Kevin, and good afternoon, everyone. Yeah, we just announced our new next 5-year plan, the 10 for the Win, and it's built, and centered around the goal of becoming the most trusted, brand for mobility and convenience. So we have this ambition to reach a $10 billion Ebitda by end of FY28, and actually this strategy is built around 4 main pillars and supported by, I would say, what we call a robust foundation. Let me give you a quick overview on the four main pillars. The first one is about winning the offer. What we think here is that we need to continue to strengthen the attractiveness of our store, and by that we want to focus our efforts on enhancing our food offer, continue to make and to win and own the first for our customers, and the third one also is continuing to increase our private brand offer. We believe that with those 3 categories and focusing our effort there, we will continue to increase traffic and again being the preferred convenience for our customers. The second pillar is winning fuel. Actually, we believe that there is still a lot of untapped opportunities in fuel for us in all the markets we are present today. So we see opportunities definitely in B2B. In US, for example, leveraging what we have been able to achieve in Europe, so huge potential there. Of course, on the B2C side as well, continuing to be relevant to our customer through offers, but also being smarter and smarter in terms of pricing, and continuing to build this competitive advantage that we have been able to do on the supply chain side. The trading, we have more integration, vertical integration on the supply chain side, owning terminals in Europe, having a partnership, Muscat in US. So we are very confident that with that we can continue to win in fuel. The third pillar is about winning the customer, and here it's all about building a customized relationship experience for all our customers. We recently launched our Inner Circle, membership program in US. We already have more than 8 million actually members, and we are very pleased by the first results. And we believe that during the next 5 years there is a huge potential for us to continue to have this personalized experience, customizing the offer, and be there when the customer needs. The fourth is about winning the growth, and here it's balancing the organic growth and the strategic M&A. So on the organic growth is we have a very ambitious program to bring new stores to the industry. So we want to add at least 500 stores over the next 5 years. And on the M&A, as you know, we have announced some important acquisition the past few months. So we are about to integrate, Total Energy assets. So it's more than 2,000 stores. The Mapco also in US, and we want to continue to look at M&A opportunities in the market. And finally, I would say those 4 pillars are supported by a strong foundation. And I would say I would highlight three main focus for us on the foundation. The first one is about talent. We believe that to achieve this strategy, we will need to the right talent, to attract and retain the talent. That's for sure very important for us. second one, I think, it's sustainability and making sure that we continue to be an inclusive and safe workplace. Of course, minimizing our impact on the environment, and of course to be there for the community where we are present. And the last piece on this foundation is we have launched also a program that we call Fit to Serve. A program that aims us to be more agile, actually in terms of organization, and to help us actually to fund all the investment that we want to do across the organization. So that's basically our 10 for the win, and very excited by this program.
So as you said, M&A is a big part of that strategy. Can you talk a little bit about what investors can expect from Couche-Tard on the M&A front going forward in terms of regions, industries, the size of deals?
Yeah, so on the M&A side, first and foremost, focus is to continue to consolidate our position on the fuel and convenience. That's where we are today. That's our core business. We want to continue to focus there. So first and foremost, here it's US. We want to consolidate. It's still a very fragmented, industry. We are the second largest player there. It's with only 5% market share. So there is a significant opportunity for us to continue to consolidate the market. The second priority I would say on that focus is to continue to look at emerging markets such as LATAM or Southeast Asia. We see there that those markets are very, I would say, with a very nice growth perspective. So we want to develop our presence there, always with the same model, building, upon of strong management, local management, and when there will be opportunity, we want to explore those two regions. And the third one, it's good to continue to look at, opportunistically to look at fulfilling regional gaps in Europe. So that's what we are doing now with Total, but of course, if there is still opportunity in some areas in Europe, we want to be there and continue to consolidate our position there. So that's the first main focus, and the second one is, I would say, on a very opportunistic way as well. We want to look at adjacent retail, opportunities as well. So we believe that if there is the right opportunity coming, exploring sectors like travel retail, dollar store, QSR could be for us something that could be interesting, and we could see a lot of synergies there. So something that we'll continue to study and see if there's something that could come.
All right, so last question on M&A. Your CEO, Total, has told us back in July that it was a really favorable environment for deals. PE money was on the side, a lot of other high yield money is on the side, valuations were down. Is that still the case? And if it is, how long do you see that environment lasting?
Yeah, we definitely see a better environment for M&A in our industry compared to, I would say, a few years ago. The high interest rate, I would say, are making more difficult for non-investment actors to get money in the market, and we see also multiples going down. So that's still healthy. So we want to continue to be very disciplined in our approach and making sure that any opportunity that we see will hit our financial metrics. But definitely we are confident, and I would say here we are very well positioned. We have a very strong balance sheet. And if there is any opportunities, we believe that we will be there. So we don't know how long it will be there, but this flexibility and this robust balance sheet will help us to actionate anytime we have the opportunity actually.
So your company sold $800 million worth of 7-year Loonie bonds back in September. That was your first Canadian bond issuance first Canadian dollar bond issuance in more than 6 years. What drew you back to the Loonie market, especially at a time of such high yields?
But actually, we believe that this the spread that we get in the Canadian bond market was was actually pretty attractive. 153 basis points. When on a swap basis, when we compare that to US or Europe, we believe that it was positive and the right thing to do. We had our bond, Canadian bond arriving at maturity in July 2024, and we considered that it was the right time to take this refinancing risk off the table, and that's why we decided to make this move, and we feel good that actually with this insurance actually what we did is almost all the net of proceeds of this insurance we put it in term deposit, and we were seeing a positive carry long away, and benefiting from the yield curve inversion. So feel that that was a right decision to make at that moment.
All right, so your company's leverage ratio right now is about 1.5 times Ebitda. You've got a target of 2.25, 2.25 times Ebitda. What are the prospects for? Do you see yourself getting to that full Ebitda target or full leverage ratio target? And what would future borrowings look like in terms of duration, which currency you'd be working in?
Yeah. So currently we are at 1.5 times. Actually, when we pro forma, when we include the total, energy assets, will be roughly at 2.15. So still a gap. Versus the 2.25 times that you are mentioning, that is our comfort zone. And what we'll do there is continue to buy back shares. Okay, so we have I would say our NCIB program that is in place until April 2024, and that allows us to buy up to more than 49 million shares, up to 5% of the total outstanding shares, so we'll continue to do that. This 2.25 times, which is our comfort zone, give us actually ample incremental room, leverage room actually to go up to 3.75, 3.5, 3.70 times if we want to actionate some M&A if there is an opportunity there. So we believe that this room is ample enough to give us this flexibility and agility if it requires at any moment.
Right. So let's go beyond the company for just a moment. You have a really good window into the economy through food sales and fuel sales. What are you seeing in terms of those right now, especially in the U.S.? I see that was a little bit of a rough spot in the recent earnings that were reported. What are those indicators telling you about the economy?
Yeah, we definitely see, and this morning we reported our Q2 results, and we definitely see some belt tightening across the markets and the regions. So customers have been impacted. I would say the last 12 months by high level of inflation, now high interest rates. And so we are seeing a customer to be more cautious, and as you pointed out, we have seen our comp sales in US to be somewhat flattish, and it's true also that we had a very strong Q2 last year. When we look at US, actually, when you look at on a 2-year basis, we are still comping at 3%, but the reality is that the customer is being more cautious. The reality is that we are seeing also less subsidies. For example, the pause on the student repayment, in US, coupon, for example, in Hong Kong that have been stopped. We have seen all these subsidies that have helped and feed the consumption that it's not anymore there, and so that's impacting. And so customers are shifting. We see some shift also in terms of behavior. So they are moving towards more private brand. And that's what we see also in our sales. To give you an example, in Q2 we have seen a private brand growing by more than 30% in Canada, so very strong growth there, and so it clearly indicates that the customer is looking for value, and so we are focusing a lot of our, I would say, efforts and strategy to provide this value to the customer. So we live with the, with our inner circle program in US, the extra program that we have in Europe. We'll continue to, and we want to continue to constantly offer this value to the customer.
So your company also has a front row seat to the energy transition. I know you have a big EV charging network in Norway. There's a lot of scenarios for how the transition to electric vehicles plays out. What's your baseline scenario for how quickly those are adopted in a big scale?
We like to think about that in Couche-Tard, what happened for us with fuel, because and so our risk strategy is really based on the strategic opportunism. And what I mean by that is when we reflect on Couche-Tard history, we started our journey with a store without fuel service, and the reality is that 40 years later we have now 10,800 stores that are providing fuel services. And we see the same, I would say, the same opportunity for us on the EV. We are here, with our real estate, our network, our presence. We see an opportunity, but to continue to provide this convenience and this mobility to our customer. And EV will be part of that. And that's what we are seeing in Norway. In Norway, that is one of the front runner in terms of EV transition. We are very pleased by what we have been able to achieve there. We are seeing our EV offer to grow, to be profitable, and we see customers staying more time in our stores. So actually, it's bringing a very positive, I would say, impact for our location. Again, building on this network that we have across the market. And when we look at EV today for Europe, today it's 1,900 chargers, so just 50% more than last year, so very significant growth there. And we'll have more than 200 stations also in US. So how we look at that is really to be there when the customer the customer demand will be. So what we do actually today, it's I've been talking about the new store that we are bringing to our network. We are building both stores with all the infrastructure to be ready to set up the charger when it will be there, when it will be required by the customer. Okay, we don't want to be upfront because actually in some market the demand is not there. But yes, we are already setting our network to be prepared when the customer would like to be.
So I guess on balance, is the transition to electric vehicles, is that more of an opportunity or more of a threat or an obstacle for Couche-Tard?
It's definitely an opportunity for us. We clearly see that in Norway and in other places where EV has been implemented. We have now. It's all about convenience and location for us. And now we have some EV charging, fuel, the best convenience store experience. So actually we have a very winning strategy there. And that's what we have seen in Norway, and we are sure that we will be well positioned to further consolidate our positioning across all the market that we are, especially in US. We have more than 7,000 stores there, so we are very confident with the EV will continue to grow.
All right, Filipe, we'll leave it there. Thank you so much for joining us.
Thank you so much, Kevin. See you. Bye-bye.